Now speaking, Jason Wood, Vice President, Strategy and Corporate Responsibility. Christy Tullio and Scott Skla, the co-leaders of JOAN's interim office of the CEO, discussed the company's financial results for the quarter during an earnings call. They highlighted the significant risks and uncertainties that could affect the company's actual results compared to management's current expectations. The call also included a discussion of non-GAAP financial measures and a reconciliation between GAAP and non-GAAP financial measures. Rob Will, Executive Vice President and Chief Merchant for JOAN, joined the call for the question and answer portion. Now speaking, Christy Tullio, Executive Vice President, Chief Customer Officer. JOAN's first quarter fiscal 2024 earnings call was opened by acknowledging the retirement of Wade Miquelon as President and CEO. The Board of Directors has commenced a search for his replacement, while Scott Skla and the Speaker take on the role of the interim office of the Chief Executive Officer. JOAN plans to focus on delivering significant cash flow improvement and strengthening its top line in fiscal year 2024 by emphasizing the fundamentals that have made it the nation's category leader in fabric and sewing and a strong competitor in the arts and crafts space. This includes investing in own brands such as Place and Time, Big Twist, Top Notch, and Pop, developing creative approaches to drive in-store productivity, making the JOAN brand ubiquitous through digital touchpoints, and continuing to drive operational efficiency. Through the Focus, Simplify, and Grow initiative, JOAN is targeting approximately $200 million in annualized cost savings, which has already resulted in $89 million in year-over-year free cash flow improvement in the first quarter of FY 2024. The company delivered net sales of $478.1 million, a decline of 4% compared to the same period last year. Gross margin on a GAAP basis was 52.1%, an increase of 380 basis points compared to the first quarter of FY 2023. E-commerce sales accounted for 11.8% of revenue in the first quarter, a 30 basis point increase in the penetration rate over the same period last year. Craft technology was the primary headwind, accounting for a 390 basis point decline in comparable e-commerce sales. JOAN remains optimistic that it will be able to deliver on its full-year outlook due to healthy customer engagement in its core sewing and craft categories and its strategic focus on baseline cost reductions. Now speaking, Scott Skla, Executive Vice President, Chief Financial Officer. JOAN's strategic priorities for fiscal year 2024 are centered on winning in the core sewing and craft categories, providing a great customer experience in stores and online, and operating efficiently. In the first quarter, net sales were down 4% compared to last year and total comparable sales also decreased by 4%. Despite this, JOAN remains optimistic about their fiscal 2024 sales outlook due to healthy engagement in core sewing and crafting businesses, increased emphasis on strategic priorities, and ability to optimize promotional cadence. On a GAAP basis, gross profit was 3.4% higher than last year, largely due to continuing improvement in import freight costs. Cash benefit from lower ocean freight rates totaled $21.7 million in Q1. For the full fiscal year 2024, excess import freight costs are expected to be $90 million less than last year and fully cycle out by the end of the second quarter. Gross margin was 52.1%, an increase of 380 basis points from the first quarter of last year. SG&A expenses increased 1.5% from the previous year due to incremental costs related to incentive and stock-based compensation, inflationary pressures on labor, and other costs. Net loss was $54.2 million and adjusted EBITDA was $3.5 million. Cash and cash equivalents were $19.7 million at the end of the first quarter and the face value of debt net of cash was $1.033 billion. Inventory is down 13% compared to the same period last year. To improve cash flow, JOAN has initiated multiple actions including their Focus, Simplify, and Grow cost reduction initiative, which targets $200 million of annual cost reductions across all areas of their business. They have identified the targeted $200 million of annual cost reductions and are now focusing on implementing and executing these initiatives. This includes taking proactive steps to solidify and build on the positive impact of reduced ocean freight costs. They anticipate net sales will be between 1% to 4% lower than last year, a significant year-over-year improvement in free cash flow of $150 to $170 million, capital expenditures net of landlord contributions of $40 to $45 million, and adjusted EBITDA of $85 to $95 million. Guggenheim Partners analyst Renee Marin inquired, "Can you discuss any insights gleaned from the 2 million reactivated customers during 2022, and what strategies are in place to retain these customers for the remainder of the year?" Christy Tullio replied, "Hi. This is Chris. We're seeing great engagement from our established customer base, including from those reactivated last year and those that have been with us for several years. Transactions, sales, and customer accounts are all increasing compared to previous years." Guggenheim Partners analyst Renee Marin inquired, "Can you provide an update on the performance of the Ditto launch? How is it performing compared to your expectations? Are new customers engaging with Ditto as much as your core customer base? Rob will replied, thanks for the question. We're pleased to report that our joint venture with Singer, Ditto, has launched in 300 JOAN stores and 180 Viking galleries. We've seen great customer engagement, including downloads of individual patterns and a subscription service, and have received an average rating of 4.5 to 4.8 stars across both sites. Additionally, 100 dealers have picked up Ditto since launch. Piper Sandler analyst Peter Keith inquired, can you provide some insight on what will drive EBITDA margin improvement throughout the rest of the year? Scott Sklo replied, Peter, we've seen a sequential improvement in our top-line performance in Q1, and we're confident it will continue. We expect freight to remain a tailwind, better merchandising margins, and the full realization of SG&A savings from our Focus, Simplify, and Grow initiative in the back half of the year. This is what's driving our adjusted EBITDA outlook. Piper Sandler analyst Peter Keith inquired, is that the right way to think about it? Can you explain how cost inflation is affecting average unit retail and what impact it has on your guidance for the year? Scott Sklo replied, yes, the cost increases with our vendors led to a higher average unit retail last year. We are now selling at the price we began absorbing last year, and as the year progresses, the cost increases will be much less in the second half of the year than what we just experienced in the first quarter. Piper Sandler analyst Peter Keith inquired, at what point do inflationary pressures stop affecting your hour? Scott Sklo replied, I anticipate that we'll see the hour mix stabilize through the rest of the year. We haven't had any major price changes, just minor fluctuations. So, the hour mix should become more even over time. Loop Capital Markets analyst Laura Champagne inquired, what are the factors driving the expected decline in comp and sales this year? Christy Tullio replied, hey Laura, it's Chris. We're seeing our craft tech component become a headwind. We discussed that in the last quarter. It was 150 basis points in Q1 and will be around 100 for the rest of the year. Our sewing and craft categories are seeing great strength, so we're leaning into those core areas. The market is fairly rational and driving us to focus on our core customer and those businesses. Loop Capital Markets analyst Laura Champagne inquired, is it fair to say that the macro environment is stable given the sequential improvement you reported? Telsey Advisory Group analyst Cristina Fernandez inquired, could you please provide some more insight into the headwinds that are causing the reported comp to be down? Christy Tullio replied, yes, we strategically reduced our purchases of seasonal inventory due to the associated risk to margin and sell-through. This is creating a current headwind, but we believe it will be less significant in the coming months. We are now able to focus more on core sewing and craft categories that have been performing well. Telsey Advisory Group analyst Cristina Fernandez inquired, given the current market conditions, how are you positioning your pricing strategy to remain competitive and capture consumer value? Rob will replied, sure. It's Rob. I'm seeing success with our private brands as a result of our Focus, Simplify, and Grow initiative. We're reducing COGS costs for goods and better price core categories, allowing us to price more competitively. Christy Tullio replied, I would just like to add that our average unit retail is $5, making it a competitive option for customers regardless of their income tier. Scott Sklo replied, Christina, Scott here. We're keeping a close eye on the consumer and adjusting our processes as needed to ensure we meet their needs at the right price point. We're staying agile in this environment to stay ahead of the curve. Telsey Advisory Group analyst Cristina Fernandez inquired, could you comment on your expected debt balance and if the interest expense assumption of $100 million from the last call is still accurate for this year? Scott Sklo replied, I believe our interest expense will remain around the current rate, as we anticipate a potential uptick in rates later this year. We do not expect any meaningful changes to our net debt this year, as we focus on improving our cash flow and reaching positive cash flow in future years.